Institutional Equity Research Report, Nasdaq, YSWY, Yesway Inc., a private equity-built convenience store roll-up, rides the gas station aggregation wave.
Section 1, Executive Summary. Yesway, Inc. is a Fort Worth, Texas-based convenience store operator that went public on Nasdaq under the ticker Yesway on April 22, 2026, pricing its IPO at $20 per share and raising net proceeds of up to approximately $322 million. The company operates roughly 500 convenience stores across the central United States under two brands, Yesway and Allsup, a regional New Mexico, West Texas chain acquired in 2019 that Yesway has deliberately kept under its own name to preserve strong local brand loyalty, particularly in and around the oil and gas-rich Permian Basin. In plain terms, Yesway sells gasoline and snacks, but the more interesting part of the story is how it grows. The U.S. convenience store industry remains highly fragmented, with tens of thousands of small, independently owned gas stations still operating outside of any major chain. Yesway, originally built by private equity firm Brookwood Financial Partners, has spent the past decade buying up these smaller, family-owned stores and folding them into a bigger, better capitalized platform, a strategy commonly called roll-up or aggregation, and one that analysts increasingly believe is accelerating industry-wide as smaller operators find it harder to compete on fuel pricing, food offerings, and technology. Yesway's first quarter as a public company showed real operating momentum. Revenue grew 13.9% year-over-year to $683.6 million, and the company swung from a $5.6 million net loss in the year-ago period to $30.2 million of net income, while adjusted EBITDA more than doubled, plus 112.9% to $59.2 million. Much of that improvement came from meaningfully wider profit margins on both fuel and in-store merchandise sales, rather than simply opening new stores, a distinction that matters for understanding the quality of the company's growth. Key facts at a glance. Business: convenience store and fuel retailer operating under the Yesway and Allsup brands. IPO: priced April 22, 2026 at $20 per share. Approximately $322 million net proceeds used to repay debt, redeem preferred equity, and fund growth. Q1 2026 revenue: $683.6 million, plus 13.9% year-over-year. Q1 2026 net income: $30.2 million versus a $5.6 million net loss in Q1 2025. Q1 2026 adjusted EBITDA, $59.2 million, plus 112.9% year-over-year. Governance: controlled company. Sponsor Brookwood retains majority voting power via an Up-C structure. Current stock price: approximately $20.89, roughly in line with the IPO price, well below its post-listing 52-week high of $29.08. This report is intended to give both professional and retail investors a clear-eyed, plain English view of Yesway's business, its most recent quarterly results, and the key risks and catalysts likely to matter over the next 12 to 24 months. It is not a recommendation to buy, sell, or hold Yesway shares.
Section 2, Investment Thesis. The bull case for Yesway rests on a straightforward, well-precedented industry dynamic: convenience store consolidation. Larger, better-capitalized chains like Casey's General Stores in Murphy, USA, have historically traded at premium valuations, precisely because scale allows for better fuel purchasing terms, more sophisticated in-store food offerings, and more efficient operations than small independent operators can match. Yesway has spent years acquiring smaller stores at what are typically more attractive prices than building new locations from scratch, and its own recent quarterly results, particularly the sharp improvement in fuel and merchandise margins, suggest the underlying platform is scaling profitably. Its Permian Basin footprint also provides a somewhat differentiated demand driver. industrial oil field trucking traffic versus a pure consumer commuting fuel business. The bear case centers on capital structure and governance. Yesway remains a controlled company under an Up-C structure, with founding sponsor Brookwood Financial Partners retaining majority voting power and a substantial ongoing economic interest even after the IPO, a structure that also comes with a tax receivable agreement requiring Yesway to make significant future cash payments to Brookwood and other pre-IPO owners. The company carries meaningful leverage with a 2028 debt maturity that independent analysts have flagged as a fueling risk worth monitoring. And despite genuinely strong Q1 2026 results, the stock has traded roughly flat to slightly below its IPO price for much of its short public history, suggesting the market has not yet fully embraced the growth story reflected in the underlying numbers. Thesis in one sentence: Yesway offers direct exposure to a genuine, ongoing convenience store consolidation trend with early evidence of real margin improvement, but investors are buying into a leveraged, sponsor-controlled structure whose public market re-rating toward larger peers' valuations has not yet clearly materialized.
Section 3. Company Overview. Legal Entity. Yesway, Inc., Delaware Corporation. Up-C structure, sole managing member of Yesway Parent LLC. Headquarters, Fort Worth, Texas. Exchange/ticker, Nasdaq, YSWY. Founded, 2015 by Thomas Nicholas Trilka. Sponsor, Brookwood Financial Partners, Private Equity. Brands, Yesway and Allsups, acquired 2019. IPO date and price, April 22, 2026, at $20 per share. Governance status, controlled company. Brookwood retains majority combined voting power via Class B common stock and LLC interests. Corporate milestones. Date, milestone, 2015. Yesway founded by Thomas Nicholas Trilka, with backing from private equity firm Brookwood Financial Partners. 2019. Acquires Allsups, a regional convenience store chain concentrated in New Mexico and West Texas, significantly increasing Yesway's scale while preserving the Allsups brand name at legacy locations. 2015 to 2026. Continues acquiring smaller, independently owned convenience stores across its core markets as part of an ongoing industry consolidation, aggregation strategy. March 30, 2026. Publicly files S-1 with the SEC for a proposed Nasdaq IPO. April 13, 2026. Sets IPO terms: 13.95 million shares at $20 to $23 per share. April 22, 2026. Prices IPO at $20 per share. Begins trading on Nasdaq under ticker YSWY. Net proceeds of up to $322 million used to redeem preferred equity, repay debt, and purchase LLC interests from existing owners. June 2, 2026. Reports first quarterly results as a public company, Q1 2026, 3 months ended approximately March 31, 2026. Business model. Yesway generates revenue from 2 core sources at each of its roughly 500 stores: fuel sales, gasoline and diesel, and in-store merchandise sales, packaged food, snacks, beverages, tobacco, and a growing food service offering. Fuel is typically a high-revenue, thin-margin business that drives store traffic, while in-store merchandise and food service carry meaningfully higher profit margins and are where convenience store operators generally make the bulk of their actual profit, which is why Yesway, like its larger peers, has been investing in differentiated food service offerings, including its own branded food program, to drive higher margin sales per customer visit.
Layered on top of this store-level operating model is Yesway's acquisition-driven growth strategy. Rather than relying primarily on building new stores from the ground up, a slower, more capital-intensive process, the company continues to acquire smaller, independently owned convenience stores and fold them into its operating platform, gaining purchasing scale on fuel and merchandise while applying Yesway's operating playbook to improve the acquired store's profitability over time. The company has also been rationalizing its portfolio, with 29 underperforming stores in Iowa and Kansas held for sale and expected to be divested by the end of 2026, a sign of active portfolio management rather than growth at any cost. Think of Yesway as running two businesses at each store, a low-margin gas station that gets people in the door and a higher-margin convenience store and food counter that's where the real profit comes from, while simultaneously acting as a consolidator, buying up smaller competitors across its core Midwest and Southwest markets, faster than it could grow by opening new stores alone.
Section 05. Products and Services. Core offerings. Yesway stores sell fuel alongside a broad convenience retail assortment. Packaged bakery items, bottled water, salty snacks, bagged candy, jerky, chips, milk, bread, eggs, packaged beverages, meat snacks, chocolate, and nuts. The company has also built out a food service program, including its own branded offerings, such as freshly prepared items, designed to drive higher margin, repeat customer visits beyond simple fuel fill-ups. Ancillary services. Beyond fuel and food, Yesway stores offer a range of ancillary services designed to maximize revenue per store visit and per square foot. Cash ATMs, cryptocurrency ATMs, money order services, gift cards, propane tank exchange, in-store gaming terminals, Amazon lockers, and lottery ticket sales. This diversified service mix is a common strategy among convenience retailers to generate incremental, high-margin revenue streams that don't depend on fuel price volatility. Store footprint. Yesway operates under two brand names, the primary Yesway banner and the regionally beloved Allsup brand, retained at legacy locations following the 2019 acquisition, concentrated in New Mexico and West Texas, including significant exposure to the Permian Basin oil and gas region. As of the most recent quarter, the company disclosed 29 stores in Iowa and Kansas classified as held for sale, expected to be divested by year-end 2026 as part of ongoing portfolio optimization. How to think about it? Yesway isn't just a gas station chain, it's trying to be a full-service neighborhood convenience destination, layering financial services, package delivery, and entertainment on top of fuel and food to capture more spend per customer visit.
Section 6. Industry Overview. The U.S. convenience store industry remains remarkably fragmented relative to many other retail categories, with tens of thousands of independently owned, family-run gas stations still operating outside of any major branded chain. Independent analysis is characterized an accelerating gas station aggregation trend, in which smaller, family-owned stores increasingly sell to larger, better-capitalized operators who can offer superior fuel purchasing economics, more sophisticated food service programs, and modern technology, payment systems, loyalty programs, and digital ordering that independent operators struggle to fund on their own. This consolidation dynamic has historically rewarded scale. Larger, publicly traded convenience chains, such as Casey's General Stores and Murphy USA, have commanded premium valuations relative to smaller peers, reflecting investor confidence in their ability to keep growing profitably through both same-store sales improvement and continued acquisitions. Yesway's IPO and subsequent growth strategy position it to participate directly in this consolidation wave as both an acquirer of smaller independent stores and, potentially, a candidate for further re-rating as it demonstrates sustained, scale-driven margin improvement. Section 7. Market Opportunity. Yesway's core growth opportunity is straightforward. Continue acquiring independently owned convenience stores across its existing Midwest and Southwest footprint, applying its operating playbook, fuel purchasing scale, food service upgrades, ancillary service rollout to improve acquired stores' profitability, while selectively divesting underperforming locations, like the 29 Iowa and Kansas stores currently held for sale. The company's Permian Basin exposure also provides a somewhat differentiated growth driver tied to industrial oil field and trucking activity, offering some insulation from a pure consumer commuting fuel demand profile and reducing near-term sensitivity to electric vehicle adoption trends, which remain most concentrated in passenger vehicle segments. Independent analysis, Seeking Alpha, has framed Yesway's opportunity explicitly around valuation convergence with larger peers. The analysis cited potential for meaningful share price upside as Yesway's valuation multiples move toward those of Murphy USA, with longer-term potential to approach Casey's General Stores level valuations as the company continues demonstrating scale and margin improvement over time. This framing ties Yesway's investment opportunity directly to its ability to keep executing the consolidation and margin improvement strategy already visible in its Q1 2026 results. How to think about the opportunity? The opportunity here isn't really about opening more stores from scratch. It's about continuing to buy smaller competitors at reasonable prices and running them better, while the broader market slowly recognizes that Yesway deserves a valuation closer to its larger, already proven convenience store peers.
Section 8. Competitive Landscape. Competitor. Listing. Positioning. Casey's General Stores. Nasdaq, CASY. Large-scale Midwest convenience chain widely regarded as an industry-leading operator, particularly for its food service program. Commands a premium valuation multiple, often cited as a long-term re-rating benchmark for smaller peers like Yesway. Murphy USA, NYSE. Large, fuel-focused convenience retailer, often cited as a nearer-term valuation benchmark for Yesway, given a somewhat more comparable fuel-heavy revenue. 7-Eleven, 7&I Holdings, Tokyo Stock Exchange. Largest global convenience store operator by store count, competes for consumer mindshare in food service innovation across shared U.S. markets. Circle K, Alimentation Couche-Tard, Toronto Stock Exchange. Major North American and global convenience/fuel retailer with substantial scale advantages in fuel purchasing. Independent, family-owned operators. Private. Yesway's primary acquisition targets rather than direct, steady-state competitors, the fragmented base from which Yesway continues to consolidate market share. Where Yesway stands. Yesway is meaningfully smaller than Casey's General Stores, Murphy USA, 7-Eleven, or Circle K, but its core competitive argument is that it offers a more direct, pure-play way for public investors to gain exposure to the ongoing convenience store consolidation trend at an earlier stage than those larger, already scaled peers. The company's regional strength in New Mexico and West Texas via the well-established Allsup brand and its differentiated Permian Basin fuel demand exposure provides some competitive insulation, though Yesway will need to continue demonstrating the kind of margin improvement seen in Q1 2026 to justify a valuation re-rating toward its larger, more established competitors. Section 9. Management Team. Thomas Nicholas Turkla, Founder. Founded Yesway in 2015 and built the company with backing from private equity firm Brookwood Financial Partners through a combination of organic growth and the significant 2019 acquisition of the Allsups. Sponsor and Governance. Brookwood Financial Partners, the private equity firm that backed Yesway's founding and growth, retains substantial post-IPO influence over the company. Per the company's IPO registration statement, Brookwood, through blocker shareholders and direct-indirect LLC interest ownership, retains a majority of combined voting power via Class B common stock, alongside a majority economic interest in Yesway Parent LLC, making Yesway a controlled company under Nasdaq governance rules. This structure means public Class A shareholders have proportionately less influence over major corporate decisions than the company's headline market capitalization might suggest.
Section 10. Financial Performance. Metric. Q1 2025, Q1 2026. Revenue. Approximately $600.2 million. Implied. $683.6 million. Plus 13.9%. Net income loss, negative $5.6 million. $30.2 million. Adjusted EBITDA, approximately $27.8 million, implied. $59.2 million, plus 112.9%. Fuel margin per gallon, 35.9 CPG. 49.4 CPG. Inside merchandise margin, 34.2%, 36.1%. Store contribution, approximately $42.2 million, implied. $74.6 million, plus 72.7%. In plain terms, Yesway's first quarter as a public company showed genuinely strong operating improvement, and importantly, it wasn't just about selling more fuel and merchandise, it was about making more profit on every gallon and every item sold. Fuel margin per gallon rose from 35.9 cents to 49.4 cents, and merchandise margin improved from 34.2% to 36.1%. Both meaningful improvements that flowed through to a swing from a net loss to solidly positive net income. This kind of margin expansion, rather than pure store count growth, only one net new store was added in the quarter, is generally viewed favorably by investors, since it suggests better underlying unit economics rather than growth that simply masks weaker per-store performance. Capital structure. Yesway's April 2026 IPO raised net proceeds of up to approximately $322 million, used to redeem preferred equity, repay debt, and purchase LLC interests from existing pre-IPO owners. Despite this deleveraging, independent analysis, Seeking Alpha, has flagged the company's 2028 debt maturity as a refinancing risk worth monitoring, while noting current interest coverage remains comfortable. The company also anticipates making significant future payments under a tax receivable agreement tied to its Up-C structure, which could affect future cash flows available for growth or debt reduction.
Section 11. Detailed Analysis Latest Quarterly Earnings Q1 2026, reported June 2, 2026. Q1 2026, reported June 2, 2026, was Yesway's first quarterly report as a public company following its April 22, 2026 IPO. The company's next quarterly report, Q2 2026, is expected around August 14, 2026, and had not yet been released as of this report's date. Revenue. Revenue was $683.6 million, up 13.9% year-over-year, driven by a 16.0% increase in fuel sales and a 9.5% increase in inside merchandise sales. Broad-based growth across both of the company's core revenue streams. Gross margin. Both components of Yesway's gross margin improved meaningfully. Fuel margin rose to 49.4 cents per gallon from 39.6 cents per gallon a year earlier, while merchandise margin improved to 36.1% from 34.2%. Fuel margins can be volatile quarter to quarter based on wholesale fuel price movements, so investors should watch whether this level of fuel profitability persists in coming quarters, while the merchandise margin improvement likely reflects a more durable mix shift toward higher margin food service and ancillary offerings. Operating income.
Store contribution, a key store-level profitability metric for convenience retailers, rose 72.7% year-over-year to $74.6 million, reflecting the combined benefit of higher revenue and wider margins at the store level. Detailed standalone consolidated operating income figures, information not publicly available as a distinct line item in the specific sources reviewed for this report, beyond the store contribution and adjusted EBITDA figures cited here. Net income. Net income was $30.2 million, a dramatic swing from a $5.6 million net loss in the year-ago quarter, driven by the combination of higher revenue, higher fuel and merchandise margins, and a materially improved capital structure following the IPO's debt repayment and preferred equity redemption. EPS. Diluted EPS on a comparable standardized public company share count basis for Q1 2026, information not publicly available in the specific sources reviewed for this report. Given the company's Up-C structure with both Class A and Class B shares outstanding, readers should consult the complete Form 10-Q on SEC EDGAR for the precise per-share calculation methodology. Cash flow and balance sheet. Detailed standalone cash flow statement in full balance sheet figures for Q1 2026, information not publicly available in the specific sources reviewed for this report, beyond the capital structure changes discussed in Section 10, debt repayment and preferred equity redemption using IPO proceeds. Readers should consult the complete Form 10-Q financial statements on SEC EDGAR for full detail.
Guidance. Specific, formal, forward, quarterly, or annual financial guidance figures, information not publicly available in the sources reviewed for this report. Management's stated strategic priorities include continued store acquisitions, completing the divestiture of the 29 Iowa/Kansas stores held for sale by year-end 2026, and continued investment in differentiated food service offerings. Management commentary. Specific quoted management commentary from the Q1 2026 earnings call beyond the operational and financial results summarized above, information not publicly available in the sources reviewed for this report. Readers can access the full Q1 2026 earnings call transcript via the company's investor relations resources for complete management remarks. Key changes versus previous quarter. This was Yesway's first quarterly report as a public company following the April 22, 2026 IPO. The company's capital structure was materially strengthened following the IPO's debt repayment and preferred equity redemption, contributing to the swing from a net loss to solid net income.
Both fuel and merchandise margins expanded meaningfully year-over-year, suggesting improving underlying unit economics rather than growth driven purely by new store openings. Only one net new store was added in the quarter. The company disclosed 29 stores in Iowa and Kansas as held for sale, signaling active portfolio optimization alongside continued acquisition-driven growth elsewhere. Section 12. Growth drivers. Continued convenience store aggregation. Ongoing acquisition of smaller, independently owned convenience stores across Yesway's core Midwest and Southwest markets represents the company's primary, historically proven growth lever. Sustained fuel and merchandise margin expansion. If the sharp margin improvements seen in Q1 2026, fuel margin up to 13.5 cents per gallon, merchandise margin up to 190 basis points, prove durable rather than one-quarter anomalies, they would meaningfully strengthen the company's underlying earnings power independent of further acquisitions. Food service program expansion. Continued investment in differentiated, higher-margin food service offerings provides a lever to drive both higher sales per customer visit and improved overall merchandise margins. Plus, Permian Basin industrial demand. Yesway's fuel demand exposure to industrial oil field and trucking activity in the Permian Basin provides some differentiation and potential insulation from broader consumer fuel demand softness or long-term EV adoption trends. Plus, portfolio optimization.
The planned divestiture of 29 underperforming Iowa, Kansas stores by year-end 2026 should improve overall portfolio quality and could free up capital for redeployment into higher return acquisitions or debt reduction.
Section 13. Key risks. Sponsor control/controlled company structure. Brookwood Financial Partners retains majority voting power through Yesway's Up-C structure, meaning public Class A shareholders have limited influence over major corporate decisions relative to their economic ownership stake. A tax receivable agreement payment obligations. The company anticipates making significant future cash payments to Brookwood and other pre-IPO owners under its tax receivable agreement, which could meaningfully affect future free cash flow available for growth investment or debt reduction. Leverage and 2028 debt maturity. Despite IPO-related deleveraging, independent analysts have specifically flagged the company's 2028 debt maturity as a refinancing risk worth monitoring, even though current interest coverage is described as comfortable. Fuel margin volatility. The sharp Q1 2026 improvement in fuel margin per gallon from 35.9 to 49.4 cents may partly reflect favorable wholesale fuel price movements rather than a fully durable structural improvement. Fuel margins can compress quickly if wholesale prices move against retailers. Integration and execution risk on acquisitions. Yesway's growth strategy depends heavily on successfully identifying, acquiring, and integrating smaller independent stores at attractive prices and improving their profitability, a process that carries inherent execution risk at scale. Competitive pressure from larger, better capitalized chains. Casey's General Stores, Murphy USA, 7-Eleven, and Circle K all have greater scale, fuel purchasing power, and financial resources than Yesway, potentially limiting the company's ability to compete for the most attractive acquisition targets or prime real estate locations. Long-term EV adoption risk. While management and independent analysts view EV adoption as a slow-moving, non-near-term risk, given Yesway's industrial/trucking fuel demand exposure, a longer-term acceleration in EV adoption could eventually pressure fuel volumes and associated in-store traffic. A limited public trading history. With only a few months of public trading history since its April 2026 IPO, Yesway has a limited track record for investors to evaluate consistency of execution, and the stock has traded in a wide range, $18.92 to $29.08 over its short trading history, reflecting this uncertainty. Section 14. Valuation. Metric. Value. Current share price, late July 2026. Approximately $20.89. IPO price, April 22, 2026, $20. Market capitalization, approximately $1.32 billion. 52-week trading range, $18.92 to $29.08. Q1 2026 adjusted EBITDA annualized reference, $59.2 million. Single quarter. Average analyst price target, approximately $29 per public.com aggregated data. Yesway currently trades roughly in line with its IPO price, meaningfully below both its post-listing 52-week high of $29.08 and the average analyst price target of approximately $29 cited by aggregated data sources, suggesting the market has not yet fully priced in the margin improvement demonstrated in the company's first public quarterly report. Independent analysis, Seeking Alpha, July 24, 2026, has argued explicitly for valuation convergence toward Murphy USA's multiple is a nearer-term catalyst, implying meaningful upside from current levels, with longer-term potential for the stock to approach a Casey's General Stores level valuation multiple if the company continues demonstrating sustained scale and margin improvement. Investors should note this bullish framing reflects one analyst's independent view rather than a verified consensus, and that convenience store valuation multiples can vary significantly based on fuel versus merchandise mix,
leverage levels, and growth consistency. Section 15. Upcoming catalysts. Catalyst. Expected timing. Why it matters. Q2 2026 Earnings Report. August 14, 2026, estimated. Will show whether the sharp Q1 2026 margin improvements proved durable into a second consecutive quarter as a public company. Completion of Iowa and Kansas store divestitures. By year-end 2026, targeted. Would complete the announced portfolio optimization and potentially free up capital for redeployment. Continued acquisition announcements. Ongoing. Central to the company's core growth strategy. The pace and pricing of new acquisitions will be closely watched. Progress toward valuation re-rating versus Murphy USA or Casey's. Ongoing. A key thesis point for bullish investors. Sustained margin improvement and consistent execution would support this re-rating case. 2028 debt maturity refinancing developments. Ongoing monitoring. Maturity in 2028. Any early refinancing action or updated terms would be relevant to assessing the company's leverage risk profile.
Section 16. Long-term outlook. Yesway's long-term outlook depends on whether it can continue executing its core playbook, acquiring smaller independent convenience stores, improving their fuel and merchandise margins, and selectively divesting underperforming locations, consistently enough over multiple years to justify a valuation re-rating toward larger, more established peers like Murphy USA and eventually Casey's General Stores. The Q1 2026 results provide an encouraging early data point, but a single strong quarter does not yet establish a durable multi-year trend, particularly given the potential for fuel margin volatility and the execution risk inherent in an acquisition-heavy growth strategy. Over a longer horizon, Yesway's Permian Basin exposure provides some structural differentiation from purely consumer fuel demand-driven peers, potentially offering more resilient fuel volumes even as electric vehicle adoption gradually increases elsewhere. However, the company's leveraged, sponsor-controlled capital structure, including its tax receivable agreement obligations and 2028 debt maturity, will require continued disciplined execution to manage successfully alongside the company's growth ambitions. Section 17. Bull Case. Bull Case Summary. Yesway's Q1 2026 fuel and merchandise margin improvements proved durable across subsequent quarters, demonstrating a genuine structural improvement in the company's unit economics rather than a one-time anomaly. The company continues executing its acquisition-driven growth strategy at attractive prices as the broader gas station aggregation trend accelerates. The Permian Basin industrial fuel demand provides continued resilience versus purely consumer-driven peers. The planned Iowa-Kansas divestitures complete successfully, further improving overall portfolio quality, and the market gradually re-rates Yesway's valuation multiple toward Murphy USA and eventually Casey's General Stores levels as consistent execution reduces perceived risk. In this scenario, independent analysis has suggested potential for substantial share price appreciation, with Seeking Alpha analysis specifically citing 57% short-term upside toward Murphy-level valuations and longer-term potential toward $80 per share as the company approaches Casey's-like valuation multiples. Section 18. Bear Case. Bear Case Summary. Q1 2026's sharp fuel margin improvement proves to be a temporary function of favorable wholesale fuel price movements rather than a durable structural gain, and margins compress back toward historical levels in subsequent quarters. Acquisition integration proves more difficult or costly than anticipated, slowing the pace of profitable growth. Brookwood's continued majority control and the ongoing tax receivable agreement payment obligations limit the cash flow available for debt reduction or growth investment, becoming more pressing as the 2028 debt maturity approaches. Larger, better capitalized competitors outbid Yesway for the most attractive acquisition targets.
And the market continues to discount the stock for its controlled company governance structure and leverage profile, keeping YSWY's valuation multiple persistently below that of larger, unlevered peers, regardless of operating performance. In this scenario, YSWY shares could continue trading near or below their IPO price, despite genuine underlying operational improvement.
Section 19. Final Investment Conclusion. Yesway offers investors a direct, early-stage way to participate in the ongoing consolidation of the highly fragmented U.S. convenience store industry, backed by genuinely strong first-quarter public company results, double-digit revenue growth, a dramatic swing to solid net income, and meaningful improvement in both fuel and merchandise margins. The company's Permian Basin exposure and well-regarded Allsup's regional brand provide some competitive differentiation, and independent analysts have pointed to a credible path toward valuation re-rating as the company continues demonstrating consistent execution. At the same time, investors need to weigh this operational promise against real structural considerations. Yesway remains a controlled company under sponsor Brookwood's majority voting power, carries meaningful leverage with a 2028 debt maturity that warrants monitoring, and owes ongoing tax receivable agreement payments that could constrain future financial flexibility. The stock's current trading level, roughly in line with its IPO price and well below both its 52-week high and average analyst price target, suggests the market remains somewhat cautious despite the strong Q1 2026 print, a gap investors will want to watch resolve in either direction as subsequent quarterly results confirm or challenge the durability of the company's margin improvement. Bottom line, Yesway presents a genuine differentiated way to invest in convenience store industry consolidation with real demonstrated early operating momentum, but its controlled company governance, leverage, and single-quarter public track record all argue for continued close monitoring of subsequent earnings reports before drawing firm conclusions about the durability of its growth story. This report does not constitute a recommendation to buy, sell, or hold YSWY shares. Readers should review the company's complete SEC filings and consult a qualified financial advisor before making any investment decision.